Alrighty, I'm going to share my screen and we will be working. Here's the stuff we're going to try to work today. Hopefully we can get through most of these. So first we'll work just exercise 12.1a. So here's the book. So it says for each of the items below, indicate whether the cash flow item relates to an operating activity, an investing activity, or a financing activity. So basically put each of these things into the appropriate cash flow category. Where would it appear on the statement of cash flows? Which section? So if you recall, let's review for just 1 second. Statement of cash flows, the operating activities section, cash inflows or outflows resulting from doing anything related to your normal operations would go there. The investing activities section, cash inflows or outflows resulting from selling or purchasing long-term assets, including long-term investments, property, plant, and equipment. That would go in the investing activities section. And then finally, any cash inflow or outflow resulting from debt or equity financing. So borrowing money, receiving cash from the lender, paying the lender back the money that you previously borrowed, paying interest, or receiving cash from shareholders who are buying your stock, or paying them a dividend, for example, would go in the financing activities section. So with that in mind, letter A, cash receipts from customers for services that you've rendered. That sounds like a cash inflow from normal operations. So that would go in the operating. Let's let OA for operating activities section. We'll let IA be investing activities, and I guess what FA would be financing activities. So A would be operating activities. It's an operating activity cash flow. Part B, when we sell a long-term investment and receive cash, so the cash inflow. Oh, pretty obvious, that's an investing activity. C, when we purchase, excuse me, when we purchase plant assets, it's a cash outflow for the purchase of a long-term asset. So those go in the investing activities section. When we pay income taxes are part of normal operations. We're taxed on our income from normal operations. So paying taxes, income taxes, is an operating activity. And then part E, when we issue a bond and in return for that, we receive cash from the lender, that's a financing activity. It's debt financing. And part F, when we pay cash dividends that we had declared in the previous year, it's cash outflow for dividends. That's a financing activity. And part G, when we purchase short-term investments for cash, with cash, so it's a cash outflow for purchasing. All right, now here, this is an investing activity, but I think earlier I had defined investing activities as cash inflows or outflows resulting from selling or purchasing long-term assets. And this is a short-term asset. But since this is an investment, it goes in the investing activities section. So I guess investing activities, we should redefine it. It's any cash inflow or outflow from purchasing or selling long-term assets or short-term, including short-term investments. Any questions on exercise 12.1a? Being able to classify cash flows. That's on the exam. All right, no questions? Let's do exercise 12.6a and then 7a and then 8a. So exercise 12.6a says use this information to prepare a statement of cash flows. And we're going to be using the indirect method when we do the operating activities section. The investing activities section, financing activities section, you always just use the same method. But for the operating activities, you can use either the indirect or the direct method. So we're going to be using the indirect method for the operating activities section, but we need to prepare the whole statement of cash flows. So before we do that, let's write down, let's remember some rules. So in the operating activities section, we start with net income. And positive changes in current assets, we subtract those. Negative changes in current assets, we add those to net income. Positive changes in current liabilities, we add those, and negative changes in current liabilities, we subtract those. So if you remember these rules right here, that can help you in preparing the operating activities section of the statement of cash flows using the indirect method. Why are these the rules? It all has to do with, if you recall from last time, we could take the accounting equation and we can simplify it down to the change in cash equals the change in liabilities minus the change in non-current assets plus the change in owner's equity. So there's a positive relationship between the change in cash, which is what we're trying to explain on the statement of cash flows, and change in liabilities. That's why we add positive changes in current liabilities and we subtract negative changes in current liabilities, because there's a positive relationship between these two variables. there's a negative relationship between changes in non-cash assets and change in cash. And that, because there's a negative relationship between these two variables, that's why we subtract positive changes in current assets and we add negative changes in current assets. It all has to do with this equation. But if you just want to memorize, here are the rules. All right, with that in mind, let's do the statement of cash flows. So we have name of statement, or name of company, Hamilton Corporation. Let's see, do I have enough room here? Yeah, I probably have enough room. Then the name of statement, statement of cash flows. And then this is for a period of time, so we say for period which ended. It doesn't tell us the year, doesn't matter. We can just say, I don't know, we'll just make up a date, 12/31/2020. And then we're going to have a subheading called operating activities. Or maybe I should title it cash flow from operating activities. And then that's our heading, our subheading. And then in this section, we're going to put all the cash inflows and outflows resulting from operating activities. So again, we want to start with net income. If we're using the indirect method, we want to start with net income. That's an accrual number, positive 94,000. And we might as well first find depreciation or amortization. Both of them are here. Amortization expense is 19,000. Depreciation expense is 39,000. Both of those numbers were subtracted to derive net income, right? They're expenses. But neither of those two things involve or ever will involve cash. So we can immediately add those two things back to net income. We're trying to convert net income, an accrual number, to a cash number. So immediately let's just add back depreciation and amortization. In other words, add to net income any expense on the income statement that never involves cash. The primary example of those things are depreciation and or amortization. Bad debt expense would be another example. It never involves cash, but it is an expense. You never have to pay for it though, in terms of cash. But amortization was 19,000, depreciation was 39,000. Both of those things were originally subtracted to get the 94,000 net income. So we add those back. We undo that part. All right. And then we use these rules. From there, we use these. So we're going to subtract positive changes in current assets and so forth. So here, accounts payable, which is a current liability, it decreases by 3,000. So that's a negative change in accounts payable. Right? So the change in accounts payable is negative 3,000. Because change is always what it was at the end minus what it was at the beginning. And if it decreased from beginning to end, that change is going to be a negative number. And what do we do with the negative 3,000? We're not going to flip the sign of it. If accounts payable increases, we add that. If accounts payable decreases, we subtract that. So let me rephrase. So these rules here, how to, because you're going to get confused. We treat, these rules apply if you treat all the changes as a positive number. You just put a negative sign in front of the change. If the change was an increase, if it's current assets, you put a negative sign in front of the change if the change was a decrease, if it was a current liability. But these rules apply to treating the changes as all positive numbers, which really isn't a change then, right? Because a change is end minus beginning. It could be a negative number, but only use these rules if you're treating the changes as positive numbers, and you just use the word increase or decrease. So if it says accounts payable decreased, that's a $3,000 negative change. We're going to subtract that $3,000 negative change. So that's the way you would use these rules. Accounts receivables a current asset. It increases 10,000. An increase is a positive change. So we're going to put a negative sign in front of that 10,000. We're going to subtract the account receivable increase. Wages payable, it's a current liability. It decreases 9,000. So a decrease is a negative change. So that $9,000, we're going to put a negative sign in front of it because we have a negative change in this current liability. Amortization, we've already taken care of. We will list these things down later. The change in cash from January to December looks like cash went down by $29,000. We're trying to explain that $29,000 decrease. We'll put that down at the bottom. There's our dividend, $6,000. That goes in the financing activities section, so not here, not in the operating. Cash paid to purchase land, that would be in the investing activities section. Cash paid to retire bonds, that's in the financing activities. Cash received from issuing stock, financing. Cash received from selling equipment, investing. Depreciation, we've already done. Gain on sale of equipment, this matters. This $16,000 gain on selling our equipment, it shows on the income statement in the other revenues and expenses, gains and losses section. It's on the income statement, and you add it on the income statement to get the net income of $94,000 down here. So this $16,000 gain doesn't involve cash, but it makes this it's added to get this $94,000. So we need to subtract that. We're going to subtract that from net income. If there was a loss on sale of asset, that would be subtracted to get the $94,000 net income number, but that loss doesn't involve cash. We're trying to convert the $94,000 to a cash number, so we'd have to add the loss back. So you add losses back to net income, you subtract gains from net income in the operating activities section. I know this is a gain from selling a long-term asset, but this gain doesn't involve cash. There's no cash, and the cash received from selling the long-term asset, that's going to go in the investing activities section. But this gain, which doesn't involve cash, it's buried in this 94,000, and we're trying to turn the 94,000 into a cash number, so we have to subtract it. Gain on sale of equipment. So I guess when I redefine what goes in the operating activity section, it's any cash inflow or outflow resulting from our normal operations. Also, what also goes in there is anything that's in net income that doesn't involve cash, like depreciation, amortization, and a gain on sale of equipment. That also goes in the operating activity section. If we're using the indirect method. If we're using the direct method, we don't start with net income. So things like depreciation expense, amortization expense, and gains and losses, they're not in the operating activities section of the statement of cash flows if we're using the direct method to prepare that section. With the direct method, we only put the cash things. And these things aren't cash, so we wouldn't put those. The reason they have to go in the operating activities section is because we're using the indirect method and we're starting with net income. And we have to back these things out of net income because they don't involve cash. We're trying to convert this accrual number, net income, to cash number. Hopefully that makes sense. Inventory. We're down to here now. Inventory increase, that's a current asset. What do we do? So inventory increase, it's a positive change of 11,000. What do the rules say? We subtract positive changes. So we're going to subtract this 11,000 inventory increase. Then we have net income, and then we have our prepaid expenses increase. These are things like prepaid rent, prepaid insurance, things like that. It calls them prepaid expenses, but these are the current assets. Prepaids have increased. Again, we're going to subtract. I don't know why the word expenses here can throw you off. Prepaid rent, prepaid insurance, all of that in net went up by 9,000. So we're going to subtract. Those things are current assets. We have a positive change in a current asset. What do we do to positive changes in current assets? According to the rules, we subtract them. And then that should give us our cash flow, our net cash flow from operations. So operating activities is, so we're going to, in our calculator, we are going to take 94,000. I'll do it on the screen here. If I can, let's see. All right, so we're going to take 94,000 over here. We're going to add 39,000, the depreciation expense back. We're going to add the amortization expense back. We're going to subtract the decrease in accounts payable. We're going to subtract the increase in accounts receivable. We're going to subtract the what was the 9,000 again? The decrease in wages payable. We are going to subtract the gain. We're going to subtract the $11,000 increase in inventory. And then finally, we are going to subtract the $9,000 increase in prepaids. Leaving us with, now this is a coincidence, but the cash flows from operating activities happens to equal our net income. The fact that this number, and this number are the same is just a pure coincidence. Very rarely will they be the same. Pure coincidence. Moving on to our next section. Cash flow from investing activities. And you should know that the first section is usually the biggest. There's going to be more stuff here. Investing activities, financing are usually really small sections. There's not as much there. Cash flow from investing activities. Now let's look at the given information again. All right, which of these things are related to investing activities? Here's a cash outflow of purchasing land. So that would be a subtraction of 110,000. Here is a cash inflow that we got from selling the equipment of 13,000. So there are two things, two cash flows related to investing activities. There's the cash paid for land. And there's the cash received from selling equipment. What was that number again? 13,000. And so the net cash flow from investing activities, and I'm running out of room. I'll just say from IA is negative 110 plus 13, or negative. So a net cash outflow from investing activities. Net cash inflow from operating activities, 94,000. Net cash outflow from investing. And then let's have to start a new page here. Our third section, cash flow from financing activities. And then we go back. What are the only things on here that we haven't taken care of? Here's a cash outflow for paying dividends, 6,000. That's financing. Here's cash outflow to retire a bond, 65,000. Here's a cash inflow from selling stock, from issuing stock of 45,000. So those three things, those are the only things left on here, and those are all financing. So let's do the inflow from the stock. It doesn't really matter what order you put them in. Or you don't have to worry about that. It actually, technically does, but don't worry about that. Put them in whatever order you want to. Cash paid to retire bonds, 65,000. It's cash outflow. So we'll put the parentheses around it. And then finally, cash paid for dividends, which was 6,000. And then we have our net cash flow from financing activities. $45,000 minus 65,000 minus 6,000. Negative 26,000. So the net cash flow, the net cash outflow, 26,000 from financing activities. Now we're almost done. So now we're going to use, now we're going to add up the three sections subtotals, this number, and this number. So positive 94 minus 97, that's minus 3, and then minus 26 gets a minus 29. So we had a net outflow of cash, 29,000 this year. So a net decrease in cash of 29,000. We add that to our cash balance at the beginning of the year, which comes from the balance sheet, 31,000. And then we hope and pray that when we add the change in cash, negative 29,000, to the cash at the beginning of the year, that we get the end of cash. So the end of year, the cash should be, the balance should be $2,000. And if it's not, then we messed up. That's how you check yourself. But sure enough, cash balance December 31st, right here is $2,000. So we did it correctly. That's how you check yourself on the statement of cash flows. If the change you calculate in cash, negative 29,000, if when you add that to the cash at the beginning of the year, and you don't get the cash balance at the end of the year, then you got the wrong change. Then your 29,000 is wrong, which means something up here is wrong. Any questions on exercise 12.6a? No questions? All right, let's do the next one, exercise 12.7a. And we'll do 8a. On the final, on the exam 3, you're obviously, it's multiple choice, so you don't have to prepare a statement of cash flows. Like you don't have to do this whole thing. You do on the homework, online homework. But on the exam 3, you're still gonna have to know how to do this, right? Because I can imagine, a question, multiple choice question where I say, what's the net cash flow from operating activities? So I'm looking for this as the right answer. So there's 4 choices, and this is one of them. And then in the given information, I give you basically all of this. And you have to figure out, well, which things do I use to calculate the 94,000? So you really, knowing how to do this is very helpful. But obviously the exam is, I'm burying all these concepts in a multiple choice format. Might even be harder that way. Tracy Company reports the following amounts in their annual financial statements. So their cash flow, so on their statement of cash flows, the cash flow from operating activities was 90,000. The cash flow from investing was negative 70,000. The cash flow from financing was negative 10,000. Their net income was 44,000. Their capital expenditures, and again, capital expenditures are defined as any cash outflow resulting from purchasing property, plant, or equipment. So $31,000 of capital expenditures. They put a asterisk says this is an outflow. Well, I know it's an outflow because that's the definition of capital expenditure. Always the outflow. And then their average current assets. So the balance in current assets at the beginning of the year plus the balance in current assets at the end of the year divided by 2, the average is 80,000. And the average current liabilities is 60,000. The balance in total assets at the end of the year is 180,000. A, compute Tracy's free cash flow. Free cash flow is the cash flow from operating activities minus the capital expenditures. So cash flow from operating activities, positive 90,000, minus the capital expenditures of 31,000. So their free cash flow, 59,000. This is what they have left over from their operating activities cash flow. 59,000 is what they have left over after purchasing any property, plant, and equipment this year. Left over to do what? Well, to invest in anything else they want to. Let's go to exercise 12.6a. What would free cash flow be in this problem? And there's a problem on the exam exactly like this. Free cash flow would be cash flow from operating activities. So 94,000. And then we got to subtract the capital expenditures. What are the capital expenditures? Any cash outflow resulting from purchasing property, plant, or equipment. So we look in the investing activities section. Are any of these things cash outflows for purchasing property, plant, or equipment? Yes, one of them is this one. So free cash flow would be 94,000 minus 110,000, which is, yes, negative number. Negative 16,000 is the free cash flow. So free cash flow can be negative. You might wonder, well, how do they have 110,000 to pay for land if they only had 94,000 in cash flow from operating activities this period? Well, that's what they had in cash flow from operating activities this period, but their cash account has a balance in it. So you add that balance to this, they got more, they better have more than 110,000 or they couldn't have bought the land. But the free cash flow is just the amount of cash you generated from your operating activities this period minus the amount that you paid for property, plant, and equipment this period. So in this one, it would be a negative 16,000. Anyway, back to exercise 12.7a. Compute Tracy's operating cash flow to current liabilities ratio. The formula is just cash flow from operating activities divided by average current liabilities. So we divide by our average current liabilities. So we'll take our cash flow from operating activities, which in exercise 12.7a was given as 90,000. Right here. And we divide by our average current liabilities of 60,000. Now you might have to calculate the average current liabilities on the exam, but in this problem, they just give them to you. So it's just 9/6, or 3/2, or 1.5. And then finally, part C, the operating cash flow to capital expenditures ratio. Well, it's just the cash flow from operations divided by the capital expenditures. Instead of subtracting capital expenditures, we just divide by capital expenditures. And so 90 divided by 31 is 2.9. Any questions on exercise 12.7a? All right, let's do 12.8a. This is getting at, so this is covered in Appendix 12a, the direct method. So this exercise doesn't ask us to do a whole, oops, sorry, I've lost it. It doesn't ask us to do a whole statement of cash flows, but part A, cash paid for advertising. Calculate the cash flow in each of the following cases. What was the cash paid for advertising? Well, to figure that out, you have to analyze advertising expense on the income statement, and you have to convert that number, that's an accrual number, to the actual cash paid for advertising. So you would go find on the balance sheet any account related to advertising, and they gave it to you. There's prepaid advertising on the balance sheet. Starts with the balance January 1st of 13,000. It ends with a balance December 31st, 15,000. The advertising expense, whoops, sorry. The advertising expense we recognize this period is 62,000. Again, what's the journal entry for advertising expense? You debit advertising expense, credit prepaid advertising. So this advertising which you had already paid in advance, when the time goes by and your commercial appears on television and you get the benefit from using the asset, that means you've incurred the expense. So you credit the asset, credit prepaid advertising, and debit advertising expense. So there's the credit to prepaid advertising at 62,000. We debited advertising expense for 62,000. Does 13,000 minus 62,000 equal 15,000? Obviously not. So there's some number here, and that would be X, and that's the cash we paid for advertising. Cash that we've paid in advance for more prepaid advertising. We would have debited prepaid advertising for that amount, credit cash for X. So what is X? We know 13,000 minus 62,000 plus X equals 15,000. So X equals 15,000 plus 62,000 minus 13,000. Or if you want to rearrange this, it's the ending balance minus the beginning balance in prepaid advertising. That looks familiar. That's the change. Plus the advertising expense. So cash paid for advertising is the change in prepaid advertising account plus the advertising expense. That's the formula. You can derive the formula yourself if you just set up the T account like this. Whichever way you want to do it. I prefer doing the T account because everything makes sense. So 15 minus 13 is 2 plus 62. So they paid $64,000 this period for advertising. That's how the direct method works. You take an income statement line item. In this case, the income statement line item was advertising expense. And you see that it's 62,000, and we ask ourselves the question. That was our expense for advertising, but that's an accrual number. What do we actually pay in cash for advertising? So then you have to go analyze the related balance sheet account, which happens to be, in this case, prepaid advertising. If you see rent expense on the income statement, you got to go analyze prepaid rent. Part B, cash paid for income taxes. The income tax expense on the income statement was $31,000. The related balance sheet account to help you figure out what cash was paid for income tax this period is income tax payable. The liability, of course, normal credit balance, begins the period with a $7,100 balance. Income taxes payable at the end of the year equals $5,900. That's what they still owe the IRS as of the end of the year for income taxes. During the year, their income tax expense that they recognize, $31,000. When you recognize income tax expense, what do? You debit income tax expense, you credit income taxes payable. Does 7,100 plus 31,000 equal 5,900? Obviously not. So we must have paid some income taxes this period, satisfied some of the liability. When we pay income taxes, we debit income tax payable, reduce the liability, credit cash. We're just trying to figure out what that debit to income tax payable is. So we know 7,100 plus 31,000 minus X equals 5,900. Solve that equation for X, you get X equals 7,100 plus 31,000 minus 5,900. Or if you rearrange, 7,100 beginning balance minus ending balance plus the income tax expense. Or if we rearrange this, we can put a negative sign in front. Then we can take the change, ending balance minus beginning balance plus 31,000 income tax expense or it's the negative change in the income taxes payable plus the income tax expense. That's how you figure out cash paid for income taxes. So let's go back and just do the simplest calculation. 7,100 plus 31,000 is 38,100 minus the 5,900, and you get 32,200. What's the next one? Is there a part C? Yes. Cash paid for the merchandise that they purchased. The income statement line item is cost of goods sold expense. So you see cost of goods sold expense, 180,000. That represents the expense that we incurred for the goods that we sold this period. This is an estimate of what we paid originally for those goods, what those goods originally cost us that we sold this period. How much cash did we pay, though, for those goods that we sold this period? The goods that we sold this period, what cash did we pay to purchase those goods in the first place? That's the question. Cash paid for merchandise purchased. You have to analyze two balance sheet accounts. You have to analyze inventory, and assuming that all inventory is purchased on account, and then the account is paid off later, you also have to analyze accounts payable. If all inventory is paid in cash, then you only have to analyze inventory. But that's not how it works. Companies purchase things on account. So for this one, you're going to always have to analyze two accounts, inventory and accounts payable. So here's inventory. It's an asset. Beginning balance of 30,000, ending balance 24,000. And it said cost of goods sold expense this year is 180,000. What's the journal entry for cost of goods sold expense? We debit cost of goods sold expense. We credit inventory. Does 30,000 plus 100 minus 180,000 equal 24,000? No. We bought some inventory this period. So X is the dollar value of inventory that we purchased on account, assuming all inventory is purchased on account. It's not the cash we paid for the inventory that we sold this period. This is the dollar value of the inventory we purchased this period on account. So that's what we're first solving for. So 30,000 minus 180,000 plus X equals 24,000. Therefore, X equals 24,000 minus 30,000 plus 180,000. So $174,000 are the purchases we made this period on account. We would have debited inventory, 174,000, and we would have credited accounts payable. There's the credit to accounts payable, so we've solved for that. Accounts payable has a beginning balance of 10, an ending balance of 11. Does 10 plus 174 equal 11? No. You got to subtract something. We'll call that Y. Y is the cash we paid for merchandise this period. all merchandise is purchased on account first, and then we have to pay off those accounts. So Y is the dollar value of all the accounts that were paid off for the merchandise purchases. So it would equal, so 10 plus 174 minus Y equals 11. So rearrange that. Y equals 10,000 plus 174,000 minus 11,000. So we paid $173,000 in cash for merchandise this period. Are there any questions on exercise 12.8a? Cash paid for advertising, cash paid for income taxes, cash paid for merchandise purchased. All right, let's do the next one. 11a. During the year, Patent Corporation's long-term investments account increased 20,000. That 20,000 was the net result of purchasing stocks. So Patent purchased other companies' stocks. It's an investment. They intend to sell it later. They purchased stocks costing $85,000, and then they later sold stocks that originally cost them $65,000. They sold them at a $7,000 loss. Also, the bonds payable account decreased by $35,000, which was the net result of issuing 100,000 of bonds at 102 and retiring bonds with a face value and a book value of $135,000 at an $8,000 gain. What items and amounts will appear in the cash flows from investing activities and the cash flows from financing activities on Patent statement of cash flows? For part A, the investing activities, we just need to look at basically this sentence, this first sentence. The bond stuff is financing. So this sentence that I have highlighted is what we're going to use to answer part A. And then this sentence down here is what we're going to use to answer part B. All right. Their long-term investment account increased by 20,000. That was a net result of purchasing stocks costing 85,000. So we know they had a cash outflow to purchase stock. So that would go. They sold stocks. Then they also sold stocks that originally cost them $65,000. Stocks that they originally paid $65,000 to acquire. They sold them at a $7,000 loss. So what cash did they receive from selling these stocks? They sold them for a $7,000 loss. They must have sold them for $57,000. They originally bought them for $65,000. $58,000. They sold them for $58,000. They originally bought them for $65,000. So they took a $7,000 loss. So $58,000 is the cash received from the sale. I should line these numbers up. And so the cash flow from investing activities, or the net result of those two things, would be, there might be other investing activities they had, but the net result of these two things is a decrease of B. Also, bonds payable decreased by 35,000. That doesn't really matter, but what matters is they issued $100,000 of bonds at 102. So that when they issue a bond, it means they're borrowing money. And what's the issue price? What is the borrower? What is Patton receiving in cash? They're receiving 102 of the $100,000. Cash received from issuing bonds. $102 of $100,000. 1.02 times 100,000. So they got $102,000 cash inflow from issuing bonds. And then they retired bonds, must be other bonds, with a face value of $135,000. At the time they retired those bonds, the book value was also $135,000. And they retired them at an $8,000 gain. So what did they have to pay? What cash did they have to give up to retire the bonds? That when you're the borrower and you retire a bond, that means you pay cash. So that the lender is satisfied and you no longer owe them anything. So to pay, what cash did Patton have to give up to retire this bond? Well, you can figure it out because you know the book value at the time they retired the bonds. And again, the book value is the net of the original face value, which they said is $135,000. The net of that and whatever the discount or premium is. But the book value equals the face value. So there was no discount or premium. So they retired the bonds at face value, but they had an $8,000 gain. So their liability is $135,000. To make that liability go away, they only had to pay $127,000 to the lender in cash, thereby realizing an $8,000 gain. So only an outflow of $127,000 to retire the bonds. Right, the journal entry would have been bond payable debit for $135, credit cash for $127, and they had to pay less in cash to satisfy the liability, so there's a gain. Gain on retirement of bonds, $8,000. That's the journal entry, and we got the cash amount. We don't need the journal entry. The question doesn't ask you to do that, but. And so the net result here would be, it looks to be negative 25,000. It doesn't ask to compute the net result. Really, all it's asking for is these two lines and these two lines. Because it says what items and amounts will appear for investing and financing. There might be other line items in the financing activities section, like they could have sold some stock, right? They could have issued some of their own stock and received cash, or they could have bought a piece of equipment in the investing activities, and we don't know about that. But we do know these two things and then we do these two. Any questions on exercise 1211A? No questions. All right. Let's see, what is 10B? I'm thinking we should do problem 12-1A. Let's see, what's 10B? So we probably have enough time for one more, and then I want to wrap it up. You guys' attention spans might not be too long, especially when we're dealing with this type of material. All right, that's exercise 10B. Okay, that's good. That's testing the direct method. And what's problem 12-1A? That was the other one that I had. That's the indirect method. We've already done statement of cash flows using indirect method. We've already done a problem like that today. So let's do exercise 12-10B. We've already done one like this too, but let's just do this one. And then we'll call it a day. But again, the solutions to all of these right here are on Blackboard. If you want to do other problems and ask me for the solutions to see if you're getting them right, I would suggest doing these ones. And I believe I've sent this Word document out to everyone already, or I think it's on Blackboard as well. So you know for each chapter which ones additionally you can do and ask me for the solutions to see if you're getting them right. It would be these ones that you could do on your own. And those solutions aren't on Blackboard currently. All right, exercise 12-10B. Thurston Company's income statement contains the following data. There's their sales revenue, there's their COGS. That's their gross profit. That's not net income, but it's gross profit. Thurston's comparative balance sheets show the following data. And it says here, accounts payable relate to merchandise purchases. So everything in this balance and accounts payable, it's all related to them purchasing inventory. And they owe the supplier. All right. Compute their current year cash received from customers and cash paid for merchandise purchased. So essentially, this is just like what we did with exercise 12-8A. Although we didn't do cash received from customers in that one. But part C was cash for paid for merchandise purchases. So one of these things will be a repeat. To figure out cash received from customers, you analyze the income statement line item that you're looking at is sales revenue. Which they told us was 790,000 right here. And the related balance sheet account you're trying to analyze to figure out the actual cash you received from your customers. I mean, this is our sales revenue. That's an accrual number. That doesn't mean we've actually received that amount of cash. That's how much we've billed our customers for services rendered this period or for goods delivered because we've earned it. But have they paid us that much in cash? So to analyze that, we look at accounts receivable on the balance sheet. So accounts receivable starts at the beginning of the year with a $61,000 balance and ends the year with a $71,000 balance, a $10,000 increase. Crap, I lost internet. The internet is gone, so you guys can cannot hear me live, but of course when oh, I was muted. Sorry guys, I am back. My internet randomly cut out and it's back now. I apologize for the interruption. This is the second time it's done that. In these lectures I've been giving online over the last couple of months. I don't know why it does that. The internet company just randomly turns it off. But hopefully you guys can hear me now. Can you guys hear me? Are we back?
Yeah.
All right, thank you. It wasn't a problem with you. That was my internet. I was recording throughout though, so we should still be good. I stopped working the problem as soon as I noticed the internet was gone. So anyway, we're back here trying to figure out cash received from customers. So we have our sales revenue. That's what we've billed our customers for the goods we've given them this period. What have they actually paid us in cash? Analyze accounts receivable. What's the journal entry for sales revenue? We would debit accounts receivable, credit sales revenue. Of course, this is assuming that all items we sell we're selling on account. We're not receiving cash for any of them up front. But that's the assumption that we're going to make. And so we just need to find the plug over here. So 61 plus 790 doesn't equal 71,000. So X is the cash received from customers to pay off their accounts with us. So 61 plus 790 minus X equals 71,000. So that means X equals 71,000 minus 61,000. Wait, let me think about this. Make sure I do it right. 61 plus 790 minus X equals 71. So X equals 61,000 plus 790 minus 71,000, or 780,000. So our cash received from customers is 780,000. We would have debited cash 780, credited accounts receivable 780, because they're paying off their account. And then finally, the last part of exercise 1210B. So we figured out the cash received from customers. Now let's figure out cash paid for merchandise purchased.
Oh, we can't see your screen.
Oh, thank you. Whenever the internet cut out, it stopped sharing my screen and I forgot to reshare it. Sorry about that. All right, so let me go back then since you couldn't see. So cash paid, cash received from customers. Again, you look at sales revenue and then you analyze accounts receivable right here. Sales revenue is the journal entry when you sell stuff on account is you debit accounts receivable, you credit sales revenue. So that's why I have the 790 over here. And then you realize that 61 plus 790 doesn't equal the ending balance. So we must have credited accounts receivable. That credit to accounts receivable is the cash that we received from our customers. When we receive cash from customers, we debit cash, we credit accounts receivable. They're paying off their account. And we just have to solve for X, and that's what I did here. So X equals 780,000. All right. Cash paid for merchandise purchased. The income statement line item that you analyze, that you look at, is cost of goods sold expense, which they told us was 550,000 right here. And then you analyze two balance sheet accounts that are related to that. First one being inventory, and the second one being accounts payable. So first, inventory. And we're assuming that all inventory we purchased on account. So inventory starts with $96,000 balance and ends with $120,000 balance. Cost of goods sold. We debit cost of goods sold expense and we credit inventory, right? When we sell an item from our inventory. In addition to debiting accounts receivable and crediting sales revenue, we also have to show that the item left inventory. So we debit cost of goods sold expense and we credit inventory. Does 96 plus 550 equal 120? No. So there's some plug over here. X would be our purchases of inventory on account. And it would equal, let's see, 96 minus 550 plus X equals 120. So X equals 120 minus 96 plus 550. Or what? 24 plus 550. 574. So we made $574,000 of purchases of inventory on account. So debit inventory, credit accounts payable. But what did we pay for in cash for the stuff that we purchased on account? Well, let's analyze accounts payable. Accounts payable starts with a balance of 35, ends with 31. And we ask ourselves, does 35 plus 574 equal 31? No. We must have debited accounts payable. We must have paid off some of our accounts this period. So Y would be the cash paid for merchandise purchased. So 35 plus 574 minus Y equals 31. So Y equals 35,000 beginning balance plus the 574 minus $31,000 ending balance. So we paid in cash this period $578,000 for merchandise purchased that we originally purchased on account. Cash received from customers, right there. Cash paid for merchandise purchased, right there, and that's exercise 1210B. Any questions on any of the things we've done up to this point? Stop sharing my screen here. No questions? Well, I think that's going to wrap up the lecture today. Remember to study, and see you guys on Tuesday for the review session at 11:40 a.m. Take care, y'all.